Okay, hopefully my mic is finally working. So this video is going to be kind of my complete model that I'm going to be looking for moving forward, as well as kind of how I see balanced versus unbalanced price ranges as pivot points in the market. So this is the full schematic, where essentially after we have any sort of given price range established, once we get some sort of strong displacement, a high time frame market structure shift, after we sort of like sweep high time frame time cycle liquidity or something like that, I'll be looking for a fair value area to be created and for it to be unmitigated. So here we retrace, but we don't actually retrace in the high, and then oftentimes price will just do whatever, and we don't look for a long entry until we actually tap back into that price level. Then you drop to the lower time frames, look for that totally invalidated market structure shift, which is essentially just the same thing on the high time frame as it is on the low time frame. So then your targets are going to be the original consolidation of the retrace, and then also this imbalance price range if there's any on the left side of the curve, as well as the external liquidity depending on what the highest time frame is saying, and that kind of determines whether or not we'll reach all the way to that liquidity. So just kind of a note on how I see balanced versus imbalanced price ranges is that here all of the green is balanced, as well as the gray, and then the red is imbalanced. So for example, if price is expanding higher, retracing into these old highs, but then for example we retrace but we don't actually balance out this price range here, that's an imbalanced price range. We might continue to expand higher and create this balanced price range above, but if we get that totally invalidated market structure shift, then that signals that we're likely going to start a sell program and drop to at least this imbalanced price range, which price will either stop at and then reverse to continue higher, or displace through and then continue on lower. It all depends about what the higher time frame is saying. Oftentimes you can get really tight entries on this. You can just kind of set your limit at this level. And here's kind of an example of what that might look like. So this is on the 15 second, I believe, where price has continued running higher. Here we actually leave this gap. We don't actually touch back into this highs, but then all through here, this is all balanced. And then once we get up to here, we see that we have these highs that we displace through. We form a low, and then we continue higher, but we haven't actually balanced out this. Then we tap it, reject, so now it's balanced. But then we displace through it, and then we retrace into it. These wicks right here reject, so that gives us our totally invalidated market structure shift, and I'm expecting that we continue to retrace lower into this imbalanced price range. And obviously my drawn liquidity was up here because that's just what my high time frame was telling me, so I was expecting us to continue to drop lower and then reverse. So this is kind of what ended up playing out. We dropped lower, and then we've just been chopping up inside this range. So obviously price will just consolidate, and then you want to trade only when price actually reaches your points of interest, so like these high time frame for value areas. But yeah, that's kind of how I view these imbalanced price ranges as pivot points in the market. Here's an example of me trading some consolidation and what that might look like. So here we have this old low that we displace through, and we tap it right here. It's kind of hard to see, but we wick into it, reject, displace through it, and then retrace, but we don't actually retrace into it. So this is imbalanced while this box down here is balanced. So as price continues higher, then we displace through this high, we reject, 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 displace through, and then I set my limit order right at this low, about 4-point stop, and then I was expecting us to run to this low, this old high, and then continue higher because my drawn liquidity was up here. So what ended up playing out is that short understood, and then went long. We got a rejection, but then we continued lower into a previously utilized fair value area before we finally began our run higher. And so at these fair value areas, you'll oftentimes get rejections, even if it's not actual true low or high of that move. But